In this video, we're going to talk about period costs. Now, when we think about the different ways to break up costs in a manufacturing firm, we've got product costs, which we had a previous video talking about product costs, and with product costs, you've got let's see here. So we got product costs. We've got the direct materials, direct labor, manufacturing overhead, and all these things, they get attached to the product itself. Right? They flow with the product through the firm. They go inventory, and then ultimately, when the product's sold, they go to cost of goods sold. So that's product costs. But when we have period costs, so these period costs, basically period costs are expensed immediately. Okay, I probably should have put that under there. So period cost is expensed as incurred. So you might say, okay, well, what is a period cost? Well, there's things like basically selling, general, and administrative costs, SG&A. So marketing expense, the CEO's salary, these types of things. Basically, all costs that are not product costs. So if it's not a product cost, if it's not inventoriable, then it's a period cost. All costs that are not product costs are period costs. So that's kind of an easy way to categorize it, and it's an easy way to deal with it because we're just going to just say, okay, well, we're just going to go ahead and we're just going to expense as incurred. That just means in the period, let's say it's year one, we incur $20,000 in period costs. Well, then we expense them in year one. Whereas with product costs, we're going to say, okay, well, let's put it in inventory first, and then when we sell the product, it goes to cost of goods sold, and that's when it flows out of the firm. So let's do a short example here. That might make this a little easier to understand. So in our example, let's look at a simple firm with 2 years, and in year one, let me scroll down a little bit more. In year one, let's say we have $80,000 in product costs, and then let's say we have $30,000 in period costs. Okay. Now we don't sell any of the product. Okay, so there's no sales. We just make the product in year one. In year two, we're not going to have any product costs at all. Let's say there's zero for whatever reason we decide to stop producing. No product costs, and then we have $20,000 in period costs. This will make it an easier example to understand what no product costs in year two. Okay, so what we're going to have happen here is this. Oh, and let me just specify, in year two, we sell all products from year one. Y1, I'll call it. Okay, so basically, this $80,000 in product costs in year one, since there's no sale, since we haven't sold the product yet, what's going to happen is that $80,000 is going to attach itself to inventory. Right? So now we're going to have inventory. It's going to go up $80,000 plus $80,000. Okay, the $30,000 of period costs, that's just going to be expensed. We're going to expense that right now. So that's going to show up in the income statement. So in our income statement for year one, we're going to have a $30,000 expense of these period costs, whether it be marketing, whatever they are. But the $80,000, the direct materials, all those things that they get attached to the product as inventory. And because we haven't sold the product yet that we just manufactured, this is going to be an asset that's going to go on our balance sheet. So even though technically we have $110,000 in combined costs here, we don't have $110,000 expense. We only have $30,000 of expense in year one, because the $80,000 is becoming inventory, and it's going to be expensed in year two. And why is it going to be expensed in year two? Because that's when we're selling all the products. Right? We assume that everything that we make, all this product cost that we're attached to our product, it's gonna flow with the product. And when the product flows out of the firm, that's when the cost will flow out of the firm through cost of goods sold. So cost of goods sold is basically it's like an expense. It's something that's going to reduce revenue on the income statement. Right? This is going to go on the income statement. So basically, this $80,000 is going to be expensed, just not in year one. It's going to be expensed in year two when we sell the products. So that's why it's a product cost. It becomes part of inventory, and it moves with the product through the firm. And when it flows out of the firm, when the product flows out, that's when the costs flow out through cost of goods sold. But in year two, we're not only going to have this cost of goods sold from the product that we're now selling that we made in year one, we're also going to have a $20,000 expense from the period costs in year two, right? So think about it like this. Period costs, as soon as you incur them, so these $30,000, we expense it now, right? But the product costs gets attached to the product itself, and it only flows out of the firm when we sell the product in that period, and it comes out through cost of goods sold.